Welcome to Wealthfinity, your go-to channel for all things finance and investment related. Today, we're going to take a closer look at two popular exchange-traded funds, ETFs, VOO and IVV, and compare their performance. With so many investment options available, it can be challenging to determine which ETF is right for you. Therefore, we will analyze their historical returns, expense ratios, and other essential factors to help you decide which fund may be the better investment option. So, sit back, relax, and let's find out which ETF is winning the race, VOO or IVV. Investing in exchange-traded funds, ETFs, has become a popular way for individuals to build their wealth over the long term. ETFs are investment funds that are traded on stock exchanges like a regular stock, but offer exposure to a diversified portfolio of assets. Two of the most popular ETFs on the market are the Vanguard S&P 500 ETF, VOO, and the iShares S&P 500 ETF, IVV. In this video, we'll compare VOO versus IVV investment funds to determine who is winning. VOO and IVV both track the S&P 500 index, which is a benchmark index that measures the performance of the top 500 publicly traded companies in the United States. This means that both ETFs offer similar exposure to the U.S. stock market. However, there are some key differences between the two ETFs that investors should consider when deciding which one to invest in. What are VOO and IVV? Before diving into a comparison between VOO and IVV, let's first understand what these ETFs are. VOO is an ETF that tracks the S&P 500 index, which is a benchmark of 500 of the largest publicly traded companies in the United States. The fund is managed by Vanguard, which is known for its low-cost, passive investment products. VOO aims to provide investors with exposure to the entire U.S. stock market, which can provide long-term growth potential. IVV is another ETF that tracks the S&P 500 index, but it is managed by BlackRock, one of the largest investment management firms in the world. Like VOO, IVV aims to provide investors with broad exposure to the U.S. stock market and long-term growth potential. Expense ratios. When it comes to investing, it is important to keep fees and expenses in mind. The expense ratio is the annual fee that an ETF charges to manage the fund. VOO and IVV have very similar expense ratios. VOO has an expense ratio of 0.03%, while IVV has an expense ratio of 0.04%. Although the difference between the two may seem small, it can add up over time, especially for long-term investors. However, it is important to note that both of these expense ratios are considered low, especially when compared to actively managed funds. Market capitalization. Another key factor to consider when comparing VOO and IVV is market capitalization. Market capitalization refers to the total value of a company's outstanding shares of stock. In other words, it is the total dollar value of all shares of stock that a company has issued. VOO and IVV have similar market capitalizations, but VOO has a slightly higher market cap. As of January 2023, VOO had a market cap of around $251 billion, while IVV had a market cap of around $220 billion. Diversification. When it comes to diversification, both VOO and IVV provide investors with exposure to a wide range of companies across various sectors. This can help to reduce the risk of investing in any one particular company or sector. However, it is important to note that because both VOO and IVV track the S&P 500 index, they do not provide exposure to small-cap or mid-cap companies. Therefore, if you are looking for more diversified exposure to the U.S. stock market, you may want to consider adding additional ETFs to your portfolio that track other indexes. Which one is right for you? So, which ETF is right for your portfolio? Ultimately, the decision will depend on your individual investment goals and risk tolerance. If you are looking for a low-cost, passive investment that provides exposure to the entire U.S. stock market, VOO may be a good option. With its slightly higher market capitalization and lower expense ratio, VOO may provide slightly better long-term growth potential. On the other hand, if you prefer BlackRock as an investment manager or are looking for a fund with a slightly lower tracking error, the difference between the performance of the fund and the benchmark, IVV, may be a better fit for you. Trading volume. Another difference between VOO and IVV is their trading volume. VOO has a higher trading volume than IVV, which means that it is more liquid and easier to trade. Higher trading volume can also result in lower bid-ask spreads, which can benefit investors when buying and selling shares. However, IVV still has a significant trading volume, so liquidity may not be a significant issue for most investors. Performance. When it comes to performance, VOO and IVV are very similar. Both the ETFs have provided investors with strong returns over the long term. However, there may be small variations in returns due to differences in the way the ETFs are managed. So, who is winning in the VOO versus IVV investment funds battle? The answer is not clear-cut. Both the ETFs offer investors exposure to the U.S. stock market at a low cost, making them suitable for long-term investors. However, the differences in expense ratios, dividend payments, trading volume, and performance can make one ETF more suitable for certain investors than the other. In conclusion, both VOO and IVV investment funds offer investors a great way to gain exposure to the U.S. stock market. While there are some differences between the two funds, such as expense ratios and composition, both have performed exceptionally well over the years and have attracted a significant amount of investor interest. Ultimately, which fund is winning depends on your individual investment goals and preferences. If you are looking for a low-cost, broadly diversified fund that tracks the S&P 500 index, VOO might be the right choice for you. On the other hand, if you prefer a fund with a slightly different composition, or if you prioritize liquidity and trading volume, then IVV might be a better fit. Regardless of which fund you choose, it's important to remember that investing involves risk and past performance is no guarantee of future results. It's always a good idea to do your own research and consult with a financial advisor before making any investment decisions.